Three forces just collided that haven't happened together in 50 years. Gold exploded over $200 in a single session, blasting past $5,300 per ounce for the first time in history. Silver hit an intraday high of $96.90. The gold-to-silver ratio compressed from 82 to 56 in months. And this happened as Iran's supreme leader was killed. Oil jumped 13%. And the March delivery cycle started on COMEX, with 60% of registered silver inventory already claimed. This isn't three separate stories. This is convergence. And convergence is what rewrites price history. I'm Roxanne, and what you're about to see is the physical precious metals market breaking apart in real time. I'm Roxanne. No fluff, no sales pitch. Just verified market data and real analysis. Everything here is sourced from official reports. COMEX, Silver Institute, JP Morgan, World Gold Council. Let's break down what just happened. Starting with the numbers as of Monday, March 2nd. Gold trading at $5,378 per ounce, up nearly 2%. But here's what matters. Gold just catapulted over $200 in a single session Friday. That's one of the most dramatic safe haven rallies in modern financial history. Spot gold went from approximately $5,100 to over $5,300 in hours. No pullback, no retracement. Just relentless one-directional buying as institutional and retail investors scrambled to acquire physical gold. Silver spot price hit $94.93 Monday. Intraday high touched $96.90. Daily change plus 1.18% on top of Friday's 6.3% explosion. That means silver gained over 8% since last Thursday's close. But the number that tells the real story is the gold-to-silver ratio. It's now sitting at 56.66. That ratio was above 82 just months ago. It compressed to 56. That compression tells you silver isn't just following gold. Silver is leading this cycle. When the ratio compresses during a crisis, it means capital is rotating specifically into silver at a faster rate than gold. And that has happened in every major precious metals bull market since 1979. The 1979 Iranian Revolution plus Iran-Iraq War saw silver go from $6 to $48, a 395% gain in months. The gold-to-silver ratio compressed dramatically during that move. We're seeing the same pattern now, except this time the setup is bigger. Let me walk you through what triggered this move. February 28th. Coordinated United States and Israeli military strikes hit Iranian targets. 3 operations simultaneously. Operation Lion's Roar, Operation Shield of Judah, Operation Epic Fury. Multiple military installations across Iran targeted. Then the report that changed everything. Supreme Leader Ayatollah Ali Khamenei reportedly killed. Whether fully confirmed or not, the market priced it in immediately. Gold catapulted. Silver followed with that 6.3% single-day surge. Monday, there's no pullback. Silver pushed higher to 96.90 intraday. That price action tells you something critical. This is not a spike and fade. This is a spike and hold. When markets spike on geopolitical news and then consolidate at the highs instead of reversing, it means the new price level is being accepted as fair value. The risk premium is being baked in permanently, not temporarily. JP Morgan Global Research just lifted their long-term gold price forecast 15% to $4,500 per ounce. But their short-term target for fourth quarter 2026 is $6,300. UBS says gold could reach $6,200 by September 2026, with an upside scenario of $7,200, citing mounting geopolitical tensions. Wells Fargo expects $6,100 to $6,300 by year-end. Deutsche Bank forecasts $6,000. Société Générale says $6,000 by end of 2026. These aren't fringe analysts. These are major global banks revising forecasts upward as they watch the structural forces supporting gold intensify. Central bank demand, geopolitical uncertainty, currency debasement fears, and now direct great power military conflict in the Middle East. Gold already gained 22% year-to-date before this weekend's escalation. That rally was built on persistent inflation concerns, central bank buying from developing nations diversifying away from dollars, and ongoing geopolitical tensions. The US-Iran conflict just poured gasoline on an already bullish fire. Indian gold markets saw domestic prices jump over 3,100 rupees per 10 grams in a single day, pushing rates to 1,64,000 rupees per 10 grams. This wasn't just a Western phenomenon. This was a global rush into the ultimate monetary safe haven as the prospect of direct conflict became reality. Now let's talk about why the Middle East escalation matters specifically for silver, beyond the obvious safe haven trade. The Strait of Hormuz. 20 to 21% of global oil flows through that narrow choke point. Iran has publicly threatened closure. Tanker traffic already down sharply. Shipping insurance rates spiking. Even a partial disruption, not a full closure, just a partial slowdown, is enough to send Brent crude to $90 to $110 per barrel. Crude already jumped 13% to over $80. That's the highest level since the 2022 peaks. Why does oil matter for silver? Because energy cost is the single largest input cost in silver mining. Approximately 70% of global silver production comes as a byproduct of lead, zinc, copper, and gold mining operations. All of those operations are energy intensive. When oil goes from $65 to $80 in 3 sessions, you just raise the cost floor for every ounce of silver produced globally. The marginal cost of production rises. The break-even price for miners rises, and the fundamental floor under silver rises with it. But the oil angle goes deeper. Higher energy prices mean higher inflation. Higher inflation means negative real interest rates persist longer. The formula is simple. Real rate equals nominal rate minus inflation. The 10-year Treasury yield is sitting at 3.96%, near 4-month lows. If inflation re-accelerates because of an oil shock, real rates go more negative. And negative real interest rates are the single most powerful fundamental driver for precious metals. Every major silver bull run in history occurred during periods of negative real interest rates. 1979, 2008, 2011, 2020. We're in that environment right now, and the oil shock just made it worse. Let me take you to the second catalyst, the physical market. This is where the entire precious metals pricing system is getting stress tested. The numbers are alarming. COMEX registered silver inventory, that's the metal actually available for delivery against futures contracts, sits at approximately 86 million ounces. Total COMEX inventory around 360 million ounces, down 32% since October 2025. In a single 7-day period in mid-January, over 33.45 million ounces were physically withdrawn from COMEX vaults. That was a 26% decline in registered inventory in 1 week. Look at the demand side. Open interest for the March 2026 contract cycle stands at approximately 429 million ounces in paper claims, against 86 million ounces of registered deliverable metal. That's a 5-to-1 ratio of paper claims to physical metal. Currently, around 10,500 contracts are still standing for delivery, representing approximately 52.6 million ounces. That's over 60% of the entire registered inventory. If just 25% of open interest demands delivery, that's 107 million ounces against 86 million available. A 21 million ounce deficit with no physical metal to fill it. When delivery demands exceed available registered metal, exchanges have 3 options. Raise margins to force longs out, offer cash premiums to settle without metal, or default. The first 2 have been used repeatedly. The third has never happened at COMEX, but the margin between avoiding it and hitting it has never been this thin. The evidence for separation between physical and paper is already visible in the data. Silver is trading in backwardation, spot prices higher than futures prices. That's rare. That's a market screaming that physical metal right now is worth more than a promise of metal later. That only happens when there's genuine scarcity in the spot market. Lease rates confirm the same thing. Historically, 1-month silver lease rates range between 0.3% and 0.5%. By January 2026, they spiked to approximately 8%. Short-term spikes in February reached 6 to 7% annualized. When it costs 8% to borrow silver for a month, it means holders of physical metal do not want to let it go. They're hoarding. And when wholesale lenders hoard, the entire supply chain downstream tightens. Refiners, manufacturers, mints, ETFs, all squeezed simultaneously. Speaking of ETFs, inflows are exploding. SLV and major global silver ETFs saw over $3.4 billion in creations in a single recent week. Assets under management expanding rapidly as both retail and institutional capital pile in. Every ETF creation requires the trust to acquire physical silver. That physical silver comes from the same shrinking pool that COMEX, LBMA, and industrial buyers are all drawing from. 6 entities competing for a shrinking supply. The math doesn't add up. The Silver Institute just released their 2026 forecast. The market is heading for a 6th consecutive year of structural deficit. The shortfall projected at 67 million ounces as industrial consumption continues to outpace mine supply. JP Morgan Global Research sees silver prices averaging $81 per ounce this year, more than double the 2025 average, with the physical deficit projected to reach 245 million ounces. Total global silver supply is forecast to rise just 1.5% to a decade high of 1.05 billion ounces in 2026. Mine production expected to increase only 1% to 820 million ounces. That pace continues to fall short of industrial demand. Here's what makes the 2026 setup potentially bigger than all historical precedents. In 1979, there was no COMEX inventory crisis. There was no 6 consecutive years of global supply deficit. There was no 50% industrial demand component from solar, EVs, AI data centers, and 5G infrastructure. There was no 32% vault drawdown in 4 months. The 1979 silver spike happened on monetary demand alone. The 2026 setup has monetary demand plus industrial demand plus physical scarcity plus geopolitical crisis all hitting simultaneously. China implemented new export restrictions on refined silver starting January 1, 2026. Only large, state-approved companies can export silver, and only after obtaining special government licenses. Firms must have annual production capacity of at least 80 tons and a $30 million credit line. These requirements effectively block hundreds of smaller and mid-sized exporters who have long served as key suppliers to global industrial users. Analysts estimate 60% to 70% of global refined silver supplies could be affected. China's move is strategic. They're ensuring domestic industries, including renewables, consumer electronics, and electric vehicles, remain sufficiently supplied. But it fragments the global market. COMEX registered inventories in the United States are down nearly 70% since 2020. London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories fallen to their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. This scarcity is driving massive price divergence between paper-traded silver and real physical metal. In Shanghai, physical silver now trading significantly above COMEX futures. Regional premiums tell the story. In Japan, premiums on secondary market platforms have surged to around 60% at times, reflecting intense retail demand amid limited availability. In the UAE, particularly Dubai, premiums currently around 40%, driven by investment demand, jewelry consumption, and the region's role as a physical bullion hub. In India, silver prices hit record levels of 3,20,000 to 3,25,000 rupees per kilogram. Investment demand in India now represents over 40% of total silver demand, up from under 25% 2 years ago. Industrial fabrication, the largest component of silver demand, is projected to decline 2% in 2026 to around 650 million ounces, marking a 4-year low. The drag is coming primarily from the photovoltaic sector. While global solar installations are expected to continue rising, ongoing thrifting and outright substitution away from silver will result in falling silver PV demand. But here's the offset. Physical investment demand is exploding. The Silver Institute forecasts bar and coin demand will rise 20% to a 3-year high of 227 million ounces as Western investors finally jump on the bandwagon. Let me give you the historical context for why war specifically makes silver outperform. 1979. Iranian Revolution plus hostage crisis plus Iran-Iraq war. Silver went from $6 to $48, a 395% gain in months. 1990 to 91. Gulf War, Iraq invades Kuwait. Silver gained 13 to 15% in weeks. 2019. Iran tensions and Saudi oil facility attacks. Silver gained 25% to peak. Across 12 major geopolitical shocks from 1979 to 2024, silver averaged 15% gains to peak versus 12% for gold. Silver wins the volatility race in every crisis because it's a smaller market with dual safe haven and industrial demand creating a leverage effect. What is important is what this means for your money. Every major bank revised their precious metals forecasts upward. Bank of America lifted its gold price forecast for 2026 to $5,000 an ounce. Goldman Sachs sees the metal reaching $4,900 by December. HSBC indicates gold could reach $5,000 per ounce by 2026. ANZ predicted gold expected to rise to around $4,600 per ounce by June 2026. These are consensus targets. The upside scenarios from UBS and others go to $6,000 to $7,200. For silver, Citigroup targets $100 for March 2026. JP Morgan sees $81 average with higher floors. Peel Hunt raised its full-year 2026 forecast by 79% to $75 per ounce, and its 2027 projection to $65, while also increasing its long-run estimate from $30 to $50. The spread between the most bullish and most bearish institutional forecast is massive. That tells you even the professionals have no consensus. The market is in price discovery mode. The macro calendar matters because data releases this week will either accelerate or moderate the move. March 6th, Employment Situation Report, Non-Farm Payrolls. March 11th, Consumer Price Index. March 12th, Producer Price Index. March 18th, FOMC Policy Decision. March 27th, PCE, the Fed's preferred inflation metric. Every single one of these data points feeds directly into the real rate equation. Hot inflation prints plus a cautious Fed equals lower real rates equals higher precious metals. Weak employment plus rate cut expectations equals weaker dollar equals higher precious metals. The macro setup is asymmetrically bullish. Technical levels to watch. Silver support at $92.50 to $93. Friday's close is now a firm floor. If silver holds $94, that's very bullish. Next support, $89. The psychological $90 level. Resistance, 96 to 96 tons $50 is the immediate ceiling. A break and hold above $96.50 opens the door to $100, the massive psychological and technical breakout level. The cup and handle pattern forming on the daily chart since the January high of $121 and February low of $63 has a measured move target above $100. For gold, JP Morgan's forecast methodology implies that around 350 tons or more of quarterly net demand from investors and central banks is needed for gold prices to rise each quarter. Every 100 tons above 350 is worth around a 2% quarter-on-quarter rise in the price of gold. Looking to 2026, JP Morgan sees around 585 tons of quarterly investor and central bank demand on average, comprising around 190 tons a quarter from central banks, 330 tons a quarter in bar and coin, and 65 tons from ETFs. Central banks haven't been the only ones increasing their relative share of gold holdings. Investor demand set to expand too. In financial gold markets, investors' futures positioning remains long. While it's the quickest component from a flows perspective, futures positioning is only one relatively small part of broader gold investor holdings, which also include gold ETFs and physical bar and coin holdings. JP Morgan forecasts ongoing robust investor demand for gold, with around 250 tons of inflows into ETFs expected in 2026, while bar and coin demand is once again set to surpass an elevated 1,200 tons of annual demand. Now, the bear case. Because you deserve intellectual honesty. Here are the legitimate risks. First, a quick ceasefire or de-escalation in the Middle East removes the geopolitical risk premium. Silver could pull back 5 to 8% to $88 to $90 support. Second, if oil stays above $90 for an extended period, it triggers global recession fears. Industrial silver demand, which represents over 50% of total consumption, could decline 10 to 15%, as it did in 2008 and 2020. In that scenario, silver would lag gold. Third, recycling is the one flexible supply source. Recycling expected to rise 7% to over 200 million ounces in 2026. More supply at the margin. Fourth, if the Fed turns hawkish and raises rates to fight inflation from the oil shock, that would strengthen the dollar and pressure precious metals. Those are real headwinds. But here's the counter. Every single one of those bearish factors operates on a timeline of months to years. The bullish catalysts, war, March delivery, oil shock, are operating on a timeline of days to weeks. The 52-week range tells the full story. Low $29.62, high $121.78. That's a 466% range. In 1 year, silver gained 183% over 52 weeks. Over 10 years, 466%. Over 20 years, 768%. The long-term trend is not debatable. It's mathematically documented. Let me give you the convergence summary. 3 catalysts just hit simultaneously. A war that threatens global energy supply chains. A March delivery cycle that could expose the paper-silver system's inability to deliver physical metal. And an oil shock that raises the cost floor for every ounce of silver produced on Earth, while simultaneously driving inflation higher and real rates lower. All 3 hit at the same time on a market that was already running a 6th consecutive annual supply deficit, with COMEX registered inventory at multi-year lows, with ETF demand at record levels, with the gold-to-silver ratio compressing to levels that historically precede silver's most explosive moves. Gold already at $5,378, with major banks forecasting $6,000 to $7,200. Silver at $94.93, with analysts calling for $100 plus. $96.90 is not the destination. $96.90 is the launch pad. We just witnessed the most dramatic safe haven rally in modern financial history. Gold up over $200 in a single session. Silver spiking 6.3% Friday, holding gains Monday, pushing to 96.90 intraday. The gold-to-silver ratio compressed from 82 to 56, signaling capital rotation into silver at an accelerating pace. This happened as Iran's supreme leader was killed. Oil jumped 13%, and the March COMEX delivery cycle started with 60% of registered silver already claimed. The physical precious metals market is breaking apart. COMEX inventories down 70% since 2020. LBMA vaults down 40%. Shanghai at decade lows. China restricted exports. Lease rates at 8%. Silver trading in backwardation. ETF inflows exploding. 6 consecutive years of supply deficit. JP Morgan forecasting 245 million ounce physical deficit in 2026. Major banks revising gold targets to $6,000 to $7,200. Silver analysts calling for $100 plus. This channel exists to give you verified data and clear analysis. Not financial advice, not recommendations, just the facts. Protect your capital, manage your risk, verify everything. COMEX reports are public. Silver Institute data is public. JP Morgan forecasts are published. The numbers speak for themselves. Stay informed, stay sharp, and I'll see you in the next breakdown.